Welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan, this is Cameron Mealy, and today we will review kind of what happened in August and then also our thoughts on the economy and the markets moving forward. Cam, why don't you kick us off with a little economic update?
Thank you, Kelly. Good morning, everybody. Let's first talk about GDP. On August 25th, the Bureau of Economic Analysis released their second estimate of second quarter GDP. So we had the advanced estimate several weeks ago. Now we've got their secondary read. The revision, or secondary read, showed a decline in annualized GDP of 0.6%. That follows on the heels of a 1.6% annualized decline in the first quarter. Now we've already talked about it. You put in your executive summary. The textbook definition of a recession is 2 negative quarters in a row. That's been kind of the textbook definition, but obviously there are a lot more factors to go into it. And one of the most interesting factors that we're seeing here is if the economy really is slowing, we're not seeing it in the jobs numbers yet. So, you talk to business owners out there, you look just around at kind of the general malaise, something's going on in the economy. There is a transition. We are slowing down. I don't know if we're in a recession. No one really knows if we're in a recession. Usually you don't know that until after the fact. But something's going on. And what's interesting, though, is we saw on September 2nd, Bureau of Labor Statistics reported that total non-farm payrolls increased by 315,000 in August, with the unemployment rates ticking up slightly to 3.7%. Notable job gains occurred in professional and business services, healthcare, and retail trade. Now, on top of that, the Bureau of Labor Statistics also noted that job openings increased slightly in the U.S. to 11.2 million. Now, that 11.2 million, that's the read as of the end of July, which is the most recent numbers. But you think about August, you had 315,000 jobs added. You have 11.2 million unfilled jobs, yet you have a slowing economy. How can you be in a recession with so many job openings and a robust hiring market?
That's the
million-dollar question right there.
Well, that's what a lot of economists and strategists are debating. Mm-hmm. Is it just the technical term of a recession, or do you have to have the other factors for it to be officially a recession? One thing we do know is jobs definitely lag. Mm-hmm. So there's always a lag when you finally see jobs drop off or the unemployment numbers worsen. That's when you're already well into a recession. So that's kind of a reality. And being an inflation-driven event like this is, if you harken back to the 70s and 80s, these same debates, pull up in the Wall Street Journal from those days back in the 70s, you had the same debates going on. I think it's heightened a little bit because we are in the middle of an election cycle here. So obviously it behooves the party in power to paint things in a better light than they may be or a direction that they may be going. So there's a lot of vested interest as to create a narrative as to how bad or good things are. Now, the economy's slowing. I think that's a given. We had a lot of excesses, a lot of extra money floating around. We are starting to see deterioration. You mentioned the unemployment numbers, how the numbers you talked about are already back to July. So we've already passed another month. What do those look like for August when we start talking about that in October? So I think things are definitely slowing, and the one message, and this probably caused a lot of the economic or a lot of market dislocation in the last couple of weeks, is the steadfastness of Chairman Jerome Powell of the Fed, kind of sticking to his guns, saying that, hey, we're going to continue raising interest rates because we want to make sure we kill off inflation. And that's really a reaction against the mistakes made in the 80s where inflation showed up, they started to raise interest rates, the data may have softened a little bit, so they would cut back rates. Yeah. It was kind of a stop and start, back and forth. That kind of came to a head in the late 70s, early 80s when Paul Volcker had to get pretty draconian in his rate hikes. So the Fed has kind of said, hey, we're going to do this. We're going to continue to raise rates. And
that was going to be my next point, we certainly have a hawkish Fed right now. Absolutely. And so this strong jobs number really has given Jerome Powell and the rest of the Fed presidents, this has really given them the ammunition now to say the economy, while the GDP numbers show a drag, the employment figures are so hot, there's still so much money out there. that we've got to do something to cool off this economy. And inflation's still running at a 40-year high. So what we're seeing is, the expectation now, I think, with economists and pundits are that in September, the September Fed meeting is September 20th and 21st. There likely will be another 75 basis point increase in the Fed funds rate. If that happens, the Fed will now have done 5 rate increases for 300 basis points, taking the Fed funds rate from 25 basis points to 3.25. That's a huge one-year increase, and that's from March until September. We could still see further increases this year.
Oh, I think my expectation is you see the Fed funds over 4% within the next within the next 6 months. Mm-hmm. That's kind of the unspoken target. Some Fed governors or presidents have kind of indicated that 4+ number being the right number, between 4.5. We're definitely on the path to it. Do 75 now, another 75, we're there.
Yep.
Maybe they pause at that point, and their slowing down could just be a matter of skipping a meeting to raise, or maybe not raising as aggressively. But we are not expecting them to pull back on rates.
And really what we're talking about here is we're talking about the Fed's decision to pull money out of the system.
Right.
Whether it's to go to stop buying bonds and letting their bond portfolios roll off. But what's interesting about this is the numbers are so staggering. You think about 300 to 400 basis point increase, you're talking about hundreds of billions of dollars of additional interest payments that anybody with a variable loan is going to be paying. Corporate borrowing is going to be more expensive. Individual borrowing is going to be more expensive. It's going to be more expensive for government, local entities to borrow. So, this is really going to have a dramatic effect on the U.S. economy.
And it's going to be a lag effect. You mentioned interest rates on the individuals. Just read an article this morning where consumer debt is actually really ramped up in the past couple of months. So, things are the landscape's changing. We may end up with more people coming into the job market, even though the unemployment numbers look good. If you have more people come into the job market that stepped out of the job market, that unemployment number could change pretty quickly if you get kind of a surge of new entrants into the job market. It's going to be an interesting several months here.
Yep. So when it comes to inflation, and it comes to Fed's hawkish attitude, I wanted to read, this is from Bank of America strategist Michael Harnett. He said he expects new highs in yields and new lows in stocks after Fed Chairman Jerome Powell's keynote speech in Jackson Hole, Wyoming last week, where he hinted at an increasingly hawkish central bank that is determined to wrestle inflation closer to its 2% goal, regardless of the potential economic fallout. Quote, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses, Powell said. These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean greater pain for the longer term. So obviously, that's Jerome Powell telling you right there that the Fed is going to do everything in their power to fight inflation. They see that is the number one risk to the long-term health of the U.S. economy. And it's not the Fed's job, you hate to say it, but it's not the Fed's job to worry about retail investors and how their portfolios are doing and how this affects their retirement. They've got to think about the bigger picture. That's what they're charged with, and they are an independent body for that purpose alone.
When we've had plenty of warnings, we knew this was coming, and hey, it's happening now. We can't predict exactly how things are going to play out or try to time how things are going to play out, but the reality is we just need to prepare. We prepared the portfolios, for volatility. We know things will go up and down, but when we get to a household standpoint, that's the key with our clients, letting us know when their expenses are coming down the line, so that we can have liquidity available for them, and we're not forced to sell when things are low. And we're staying pretty defensive with our stock picks. Even though we're in the market, we moved to portions of the market we think are going to be able to withstand a economic environment of higher interest rates and probably a little bit slower growth economy. So with that said, let's talk about the portfolios, how we did in August. I'm already ahead of the game a little bit. So year to date, from an index standpoint, year to date through August, the Dow Jones was down 13.3%, S&P 500 down 17%, the NASDAQ down 24.5%. Last month, NASDAQ had gotten above down 20%, slipped back into bear market territory. Small cap stocks, as measured by the Russell 2000, down 17.9 year to date, and the MSCI EAFE down 21.2, emerging markets down 19.3. for the month, started off the month well, coming off a strong July, but Dow Jones ended up losing 4%. The S&P ended up losing 4.2%. The NASDAQ 4.6%. Russell 2000 small caps actually fared a little bit better during August, believe it or not, down 2.2. EFEA, the international market, down 5. Actually, emerging markets were flat for the month. Our portfolios, dividend yield for the month, down 3.5, taking us to a down 8.4 for year to date. So really holding up pretty well. Big gainers, British American Tobacco up 2.25 last month. And Southern Company up 1.5. Not a lot of big gainers there last month. The big laggers last month, Pfizer down 10.5, 3M down 12.3, Intel down 11.2. Year to date, our big gainers, Edison up 17.6, Southern Company up 15.6, utilities, which tend to do well when things are rough.
Defensive stocks.
Merck, we got a pretty big exposure to Merck, not just in this portfolio, but that's up 13.3% year to date. And once again, British American Tobacco up 10.5. Our laggards for the year, Intel feeling a lot of pain, down 36%. Cisco down 27.9%. Once again, Pfizer, they're struggling, down 20.5%. Eaton Company down 20%. Our growth with income portfolio, which is really our balanced portfolio, held up fairly well in August, down 3%. Year to date, down 10%. Big gainers, we added EOG, which is an oil and gas exploration company. That was up 9%. We added it at the end of the month, so we had a nice little bump there. Disney had a little good rebound, up 5.6%. And then on the laggard side, NVIDIA continuing to give us some pain, down 17%. Lennar down 9%. Nike down 7.4%. Berkshire Hathaway gave up a little bit, 6.6%. Year to date, should be no surprise, Exxon up 60%. Our commodity fund is up 20%. Pepsi eking out 0.5% there. Big laggards, once again, NVIDIA down 49%, Nike down 36%, Cisco down 27%. In our price potential portfolio, more growth oriented, down 3.75 for the month. Year to date, we're down 10.5. Big gainers, we eked out a little bit of gain in Facebook, up 2.41. Asbury Auto, used car dealer, up 1.7 for the month. Laggards, Analog Devices down 11.5, CarMax down 11.15, Danaher down 7.4. Year to date, of the stocks that still remain in the portfolio, we've had a lot of turnover in here, so that's why you don't see a lot of bigger numbers, is because we've been taking gains along the way. Asbury Auto up 1%, Humana up 4%. Year to date, Meta's given us, Facebook's given us a lot of pain, down about 51%. Comcast down 26%. Google down 25%. In the small caps, obviously small caps did fairly well last month relative to the other markets. CyberOptics up 31%. Alliance Resources up 22%. Ascent Industries up 21%. On the downside, Meyer Industries down 20.6%. PAM Transportation down 17%. And year to date, Lantheus is a big gainer. Once again, we have a lot of turnover in this portfolio also. Year to date, that we're still holding Lantheus up 172, CSW Industries up 5.21. So, bottom line, I think we have some rough sailing ahead of us. There will be some opportunities, pick up some good companies along the way. But September historically tends to be a pretty rough month. Heading into the election, expect a lot of volatility. And as always, if you see needs coming in the short term, please let us know so we can prepare the portfolios for withdrawals if needed.
Yep. And as always, if you have any questions, please feel free to give us a call. We appreciate your trust and look forward to speaking with you again next month. Thank you.